Stocks go high, inflation goes low. Let's talk about it on Today in Mortgages. Hey, what's going on, Dreammakers? Welcome back to the show. We're talking about what's real, what's hype, and what you should actually be paying attention to out there in the world of mortgage and real estate news. It's Today in Mortgage. Rich, how you doing today?
I'm good, Michael. Hope you had a great weekend.
I did. You were saying you were watching some baseball over the weekend. How'd that go?
World Series, good. My Dodgers are in it, so I'm pretty happy about it.
We also had, going into the weekend, some good data and a high market. And here we are on Monday with another record high in the stock market. We don't typically talk about that, but we're going to talk about it a little bit today as we talk about some of these indicators. You sent me an article from Yahoo Finance, says stock market today, Dow and S&P 500, NASDAQ surged to records as tame inflation cements Fed rate cut bets. This was from Friday. We're on Monday, but we're seeing more of the same today in the market. Rich, let's start with the stock market. Why are we seeing these moves? How does it affect housing? And then we'll get to inflation here in a little bit.
Sure. Well, different reasons from Monday or from Friday to today. Both days were good on the market, just different reasons. Friday, we had the CPI come in lower than expected, which was great news. Market loved that. And then today, looks like we have an actual deal with China. Everybody's looking for every positive sign possible. And framework is further along than we've been with China. So that's good news.
Now, Rich, when we talk about the stock market, obviously that is not the housing market, but does the kind of broader economy stocks affect, what we see in the bond market, and how can that affect rates on the street here?
Well, there's a few different things. One, no, the stock market really doesn't have anything to do with mortgage rates or the housing market. Inflation does. The Fed funds rate has a little bit to do with interest rate, but mainly it's the economy. So as economies grow and they're hot, rates are generally rising because of inflation concerns. So, back in 2022, we had 8% inflation, if you remember that. Just to put it into perspective, the normal is between 1.5% and 2%, which is the Fed's target rate. That's where they want it to. So we're down from 8% in 2022 to now, 3% on this last CPI report. So that's great news. But what the Fed did in 2022 was quantitative tightening, which means, just for simple terms, it's like tapping the brakes on the economy, except for they weren't tapping the brakes. It was 2 foot solid on the brakes, trying to slow it down to bring that inflation down. And then last week, we started to hear about the Fed coming off of quantitative tightening. Doesn't mean we're easing. It means we're going to stop selling bonds or letting them mature out without reinvesting. So that is good news for the mortgage market.
Yeah, and you mentioned that CPI report. We saw a 3% inflation. We expected to come at 3.1, and so that made a lot of people really happy, even though we're still 50% higher than we want to be at that 2% rate that you just mentioned as the target rate. So things going well out there, but still a little ways to go on that. But it sounds like moving forward, there is, like this article says in the headline, the Fed rate cut is kind of getting cemented for the end of the year. Do we want to talk about that at all, Rich, or make any speculation?
Sure. I mean, it sounds like, there's a 100% chance it's going to happen. We're going to get a Fed rate cut, likely going to be 25 basis points. But it's not overall going to affect mortgage interest rates. That's cost of funds are a little bit lower for overnight banking. That's what banks pay, to borrow funds overnight. So, as that Fed fund rate, we've mentioned this many times, it'll bring down, adjustable rate mortgages. It'll bring down maybe car notes and credit card interest, but that doesn't directly relate to mortgage. We got to see where the 10-year treasury is. That's what we need to look at, because the lower that trades, the lower interest rates are going to be. They generally follow each other. In normal markets, they generally follow each other. It was kind of whacked out a little bit during COVID because remember, it was the Fed just throwing money out. They were quantitatively easing everything, buying all the bonds, keeping the rate super low to kind of pick the economy back up after that little pandemic period. And that's what we're paying the price for now. But we're getting into more normal market for interest rates. So, we talked about this. We went back to 1982 and we saw the trends. It's been relatively low interest rates at least for the last 15, 20 years. Low, like 6%. That's low compared to where they have been. So we're getting to a normal place, Michael, and I'm happy about it.
That's good, Rich. We're always trying to keep our ear to the ground on what is going on out there in the market, but we're also trying to keep abreast of what's going on with you guys out there in the loan officer business. And one of the ways we're doing that is with a brand new survey from Today in Mortgage. It is a benchmark loan officer survey that gives all of you out there that want to participate a real look at where you stand in the industry compared to your peers. If you fill out the survey, you get a free report on where you stand with comp, technology, products, support, and more to understand how you can make the best choices for your career. Rich, as we talk about these things, we're looking at several positive indicators in the economy, stock market, not necessarily to do with the housing, but on top of that, we see pullback in quantitative tightening, and we're seeing a positive signs in those CPI reports. These three things together feel like we're coming into a new maybe vibe in the economy going into the end of the year. How do you feel about things right now?
I'm feeling positive vibes. That's what I'm feeling. The signs are all there. We've been talking about this for, it seems, years, and we're finally starting to see it normalize. So that, again, that's what I'm excited about. I'm trying to get all of our folks excited about seeing it, and love to see a lot of buyers getting excited about it too. In fact, we're seeing that too. We're getting refinances, and we're seeing a lot more people getting out after it, trying to get under contract on homes. So all the signs are there. They're good vibes.
Yeah, Rich, we talk a lot about headlines here on the show, and you shouldn't always take those headlines at face value, but it sure doesn't hurt to start to see positive headlines about the economy out there when it comes to those buyers and their psychology about wanting to get back into the market. And so it looks like we're seeing more of that, and there'll be more to come toward the end of the year and going into 2026. So definitely excited about that.
For sure, Michael.
Well, Rich, before we sign off on this, anything else you have on the economy or anything else in the news that we should be paying attention to right now?
Yeah, for those of our audience that aren't in the real estate or mortgage industry, I just need you to understand that the Fed fund rate does not equal actual mortgage rates. It's just the cost of funds for banks overnight, but it directly impacts the way the economy moves forward. So don't look for super low interest rates just because the Fed is dropping. That happens over time.
Yeah, and if you are interested in understanding what you qualify for, you can check us out at nflp.com and see what you would qualify for when it comes to home buying or refinance. Rich, thanks so much for joining us today, making us smart. As always, thanks to everyone out there for watching, listening, wherever you are. We appreciate you. We'll see you next time on Today in Mortgages. Today in Mortgages is produced by Network Funding LP, which is an equal housing lender, NMLS 2297. The content of this program is meant to be a commentary on mortgage and real estate news, and any discussion of rates and or products should not be taken as an individual mortgage or home buying advice or pricing estimates. And any commentary on this show should not be considered a promise to make a loan. All applicants for a loan must qualify, and you should consult a professional regarding your individual loan scenarios for your financial situation. Visit our website at nflp.com/licenses for all state licensing and other legal information.